And it's great to have you join us in another edition of your favorite weekend business program on Channels Television Capital Market. I'm Ladi Williams. Let's begin the show with a quick review of major global stock market performance at the end of this week. Major bourses around the globe were mostly positive to close yesterday. On Wall Street, the Dow Jones Industrial Average that rose, wrapping an eighth consecutive winning session and registering its best week of 2024. We see Dow Jones up 0.32%, NASDAQ down marginally, 0.03%. While in Europe now, we see European markets closed higher on Friday as positive momentum continued into the end of the week. See the FTSE 100 was up 0.63%, while the German DAX was also up 0.46%. The CAC 40 in France, that was up 0.38% to close on Friday. Meanwhile, across Asia-Pacific, Hong Kong led Asia-Pacific stocks higher as markets tracked Wall Street gains with renewed hopes for rate cuts by the U.S. Federal Reserve bolstering market sentiment. We see the Nikkei it's up 0.41%, Shanghai up marginally 0.01%, while the Hang Seng Index at 18,963 points up 2.30%. And back here, the NSE OTC securities markets performance ended the week positive with a big move up, 7.26% week-to-date gain. At the same time, the volume of securities traded this week's up 10.09% to 63.31 million, while value traded was up 26%. And the number of deals carried out, that was at 182. Top advances for the week, newest ASL Nigeria PLC, Aradol Holdings PLC with a 24.20% advance, in Afriland Properties, that was about 30.89%. Top decliners, we see Friesland Campina, Wamco Nigerian PLC, and Geofluids PLC. Those were the top losers for the week on the unlisted market. Time to look at the fixed income market and the FX markets. It was a tough week for the Naira, dipped about 2.7%. Against the dollar. Joining us now is Oladipo Ajayi, head fixed income and FX at Chapel Hill Denham. Joining us via Zoom. Great to have you on the show.
Yeah, good evening. Thank you very much, Ladi, for having me on.
Yeah, so we see the Naira there seems to have moved from best performing currency in March and immediately turned to the worst performer in April, according to reports. It looks like it's more pressure for the CBN at this point.
Yeah, as we speak currently, there's a lot of pressure on the central bank to actually quickly wade in as we speak. What's currently happening in the market is an issue of liquidity. The level of liquidity in the market is not enough to actually cushion the effect of the demand that we are currently seeing in the market. It's worthy to note that last week, Naira appreciated and closed the week around 8,354. On the NAFEM window. And but the sad news is that at the end of the trading section on Friday, Naira closed at 1,466 Naira. That's over 100 Naira loss in the market. So currently, there's still a lot of pressure on the central bank, and I think the central bank is actually looking for a way to actually work with the fiscal policy guys to ensure that there's liquidity. On the part of the central bank, their duty is not actually to raise the FX. They are actually a custodian of the fund of the government. So it's a function of the availability of funds from the government that determines what the central bank can do in the markets. And currently, we are not seeing so much influx of FX. And if you understand, on Monday, the central bank was in the market trying to issue OMO bills. And OMO bills is basically for banks and foreign investors. And again, one of the reasons is to actually further lure in foreign inflows into the market so that they can have muscle to actually meet their pending demand on the table. So I think the central bank has a lot to do as we speak currently.
Right, and it's quite interesting. You know, once we talk about Naira weakness, everyone's looking at central bank at this point. But are you expecting any intervention this week from the CBN?
Well, it has been a normal thing that we see maybe every other week. So we won't be surprised if the central bank is coming into the market this week to actually come and actually intervene in the market this week. So the central bank needs to actually do something great in the market this week by actually coming in to actually meet the demand of the market. Last week, we saw them in the market where they actually offered close to about $500 million per bank. What they did was to actually create liquidity for banks so that banks will be able to meet the demand of their clients. So we're expecting central bank to also show up in the market this week so as to actually find a way to actually douse the current pressure. Because if we don't do something now, Ladi, we may actually start down run towards the 1,800 that we touched the last time.
Yeah, that's a dreaded level at this point. I'm talking about the rate to the dollar. But we see Standard Chartered's economists saying about $1.3 billion of Naira futures are set to mature at the end, of this month. So I'm guessing that's more pressure coming.
Yeah, of course. But I'm sure the central bank has a way to actually handle such. They have been very, very innovative in a way to actually manage some of those maturing obligations. So I won't be surprised if they actually bring in one of their strategy in this time around to actually push in the effect of these maturing FX futures. I'm very sure the central bank will do something around that.
And definitely, all eyes coming again on inflation, the numbers for April, and we've seen, definitely month to month, it's been going, higher, even though we've seen some kind of deceleration. But what are you seeing for April inflation numbers?
Well, the expectation is that the April inflation number will also inch up again, maybe to 32.32 levels. And for us, we feel that the increase will not be as much as what we have seen in the past because of the conscious efforts by the monetary policy guys. You and I understand that the current inflationary pressure is not a function of only demand pull. There's an element of cost push. So it simply means that the central bank can continue to do something if the fiscal policy guys don't rise quickly to the challenges. If we don't put an end to the issue of insecurity, if we don't put an end to many other things that are actually affecting food supply into the market, we'll continue to actually move in this trajectory. And we don't want to get to a level where the actions of central bank in terms of tightening the aggressive policy will now be counterproductive rather than actually bringing a result. It will actually affect, it will further affect the situation on ground. So I think that rates will go up, but we also feel that the fiscal policy guy needs to do more currently because we can't continue in this dimension.
Right, and talking about tightening at this time, I believe the central bank MPC will be meeting sometime, maybe this month. But how much more tightening do you think the market can take going forward?
For me, I don't expect them to be extremely hawkish. I don't, because if you have seen the trajectory of things, the central bank on the terms of liquidity management, they've been very hawkish. If you look at throughout, in the last 2 months, we've been seeing in a situation whereby the market liquidity has been in negative. So it simply means that overnight our OPR rate has been trading around 30%. So when you now look at that from that perspective, what more would the central bank do? We have raised rates by over 600 basis points, by 600 basis points just in this year. And we've not seen the full effect of that. Of course, there are lag effects of some of these policies. So I think that the maximum I think that the central bank can do if they decide to toe that line is to do maybe another 100 basis points, because anything above that will worsen the situation. That's my own perspective.
Right, and talking about the situation, what are you seeing coming for the fixed income market next week?
Well, for the fixed income market, we've been seeing a bit of activity in the market, most especially on the bond segment. And when the DMO came out to rescind the 2034 from the auction calendar and introduced reopen the 2033 maturity, that also put a bit of demand on the 2034 maturity. And so also there have been aggressive demand on the long-dated instruments most especially the 2050 and 2053 maturity. There are a lot of portfolio manager, maybe they're actually more like doing asset liability management. So what they are currently looking for in the market is that they are looking for a 30-year, a 29-year bond, a 28-year bond. And as a result, we'll be seeing aggressive demand on some of these instruments. And when you look at where long-dated instrument like the 2053 is trading, currently it's trading around 17.5. When you now compare to short-dated instrument like a 2027 maturity, which is just like a 3 years to maturity, that one is trading around 19.4%. That's about 200 basis points apart. So we've been seeing more like inverted yield curve around that line. So going to the new week, we'll feel that the market will start quiet, considering that the DMO will be in the market on Monday to actually raise to actually auction across three maturity, the 2029 bond, the 2031 bond, and also the 2033 bond. So based on that, market may likely be quiet on Monday. But I feel that we'll see a lot of activity in the market from Tuesday, knowing fully well that the auction result will be more like a catalyst that will actually push a lot of activity into the market. On the treasury bill space, we'll be seeing more like a very quiet market. A lot of people are very careful in that segment of the market. Banks are not aggressively investing in the treasury bill market, knowing fully well that there's depth of liquidity in the system. Overnight, like mentioned earlier, overnight an OPR rate is trading close to 30%. As we speak. So it doesn't make sense actually raising money at 30% and buying instruments at 20%. So a lot of them are actually out of the market as we speak. Rather, they're actually selling the short-dated instrument to actually fund their obligation. So we expect to see calmness in the treasury space, but we think there will be a bit of activity on the bond space.
All right, we'll definitely be looking forward to that next week. Thank you so much. It was great having you, Mr. Oladipo Ajayi, head fixed income and FX at Chapel Hill Denham. Thank you so much.
You're welcome. Thank you very much, Ladi, for having me on.
All right, let's get a check on the domestic market now. Ended the second trading week in red as as profit taking continues, at this time with banking stocks. They continue to take the toll on the equities overall performance. I see the main index down 1.36%, bringing the month and year-to-date performance even lower. But we see year-to-date performance is looking good, about 31%. Sectoral performance mostly negative, as the banking index again was down for the week. Also see consumer goods down about 1.18%. Just the industrial goods have a marginal rise there, about 0.07%. Insurance down, that's financial services, that's also down bigger than the banking counter, 1.01%. And oil and gas, not unchanged, 0.33% down. We see top gainers, Tantalizers PLC, 27.78%, rise closing at 46 kobo, while FTN Cocoa Processors, that was up 20% at 1 Naira 62 kobo. Remember, FTN did a stellar run, that was in 2023. Presco PLC, up 15.31% for the week, 291 Naira 50 kobo. For the top decliners, now we see PZ Cousins, Nigeria PLC, 27 Naira 75 kobo, down 26.97% for the week. And Mikos PLC, 91 kobo, also down for the week. Top trades, United Bank for Africa PLC, Nigerian Breweries PLC, and Access Holding PLC, holding that top position for the trades in the market. We'll take a break now. When we come back, we'll analyze what drove sentiment in the NGX and what to expect in the coming week. That's in a moment. Do stay with us. Welcome back. Well, it's time to get a check on what drove sentiment in the equities market. Joining us now is Mr. Olatunde Molegbe, the MD, Arthur Stevens Asset Management, joining me via Zoom. Great to have you on the show. Good evening.
Good evening, Ladi. Thanks for having me.
Yeah, so still earnings at this point. Airtel Africa reporting $89 million annual losses. The Naira devaluation again hits their earnings, but still, they still quite a nice announcement there. We see the FX loss at $89 million, but dividends announcement, $3.27 per share. So I guess that's quite impressive at this point. But it seems the Naira devaluation story will keep impacting these companies for the foreseeable future. How are you seeing it?
Yes, I think so too. You must also realize that, Airtel is not only operating in Nigeria, they have opcos in several African countries. So the devaluation story is not limited to Nigeria. They are probably also taking devaluation losses from other countries. Malawi, for instance, have also seen significant devaluation. So if you look at the result itself, take out the revaluation losses issue, Airtel has done extremely well, but in as much as they have had to take these devaluation losses and have to also deal in relatively high interest rate environment, the bottom line will continue to be affected. But I think that over the next few years, hopefully that pressure will ease and the actual performance of Airtel will become obvious to all investors. But on the face of it, given the quantum of the valuation losses they've had to take, for them to still be able to come up with this kind of result and actually propose the sort of dividend they are proposing, it shows that it's a very strong company with very good prospect.
And definitely, looking at African currencies at this point, we see a lot of pressure right now, against the dollar. The DXY, that, rallied, for the week, also putting pressure on these currencies. But talk to me about how these companies, operating in Africa can somehow have some kind of hedge, against currency devaluation.
Well, outside of, trying to hedge their currency exposures by buying futures and forwards, all you could really do is to find a way of growing your margins at a pace that is faster than the currency devaluation loss you have to take. So, if your margins expand significantly, whatever loss you are taking regarding currency, the expansion in margins will probably absorb that. Unfortunately, we do not have very active or I would say very sophisticated futures and forward market in Africa at the moment, but it's still there. So those portions of those exposures, of those foreign exposures, they can hedge. It is always better for them to hedge it with futures and forwards. And, so hopefully that covers the losses at the end of their fiscal year. But other than that, it is only for them to seek to try and grow the business itself such that the profit margins is large enough to absorb those devaluation losses as we are seeing them.
All right, let's look at some regulatory issues at this time. We see the Securities and Exchange Commission in Nigeria. They've introduced some stringent new rules for the issuance and allotment of securities by private companies with fines of up to 10 million naira. How are you seeing this, and what are you expecting for compliance?
I think that is an excellent move by the new management of SEC. We must understand the context of where they're coming from with this new rule they have just exposed. If you remember, if you cast your mind back, 2006, 2007, we had a situation where lots of private companies came into the market and issued private placements, this time in terms of equities. So we had the situation where private companies were essentially selling equities to the public, which they really shouldn't be able to do. The SEC at that time, unfortunately, the argument was that, well, they are private placements, so they do not have to register those securities with us, so they do not fall under their regulatory purview. So I like very much what the present management of SEC is doing by saying we are sort of going in that direction now. But this time around, what we are seeing is that more private placements are issuing debts. in the form of commercial papers, in the form of debentures and bonds, and they're selling them to the public. So they are trying to get ahead of them by saying, okay, look, if you issue these instruments, first of all, you need to be able to show that you've operated profitably for 3 years. Second of all, you need to actually register those security with us. That way, we can actually fulfill our function of protecting the investing public, so that you don't end up in a situation where a private company issues debt to the public and they are unable to pay back, and there will be all this hullabaloo about the regulators not doing their work. So preempting the possibility of that, I think, is a very good move on the part of the SEC, and the fact that the penalty is also stiff enough to deter not only the issuer, but even the practitioners, the operators, and the issuing houses that will typically take these companies to the public from circumventing that rule. I think it's a good move. It's a good preemptive move for the possibility of ending up in a situation where private companies inadvertently take advantage of the investing public.
Right, and we'll definitely keep, tracking compliance, going forward. But let's look at the equities market now. The NGX, we're still seeing profit taking, another weekly loss there for the all-share index. And we're in May, and you know what they say about May, sell in May and go away. Is it too late, or is it happening already?
Well, I think there's a bit of that has happened. I think that we will still continue to probably see sell-offs for now, and I think it's more about the fact that the CBN continue to keep this hawkish stance regarding monetary policy. So, in as much as we still have elevated interest rates, you are still going to continue to see investors, shift their portfolios more towards fixed income and away from equities. What I've said, of course, is that I will encourage investors to always also seek to look beyond the major figures. So the major figures could very well be showing you that the market on the equity market is on the downward trend. But if you look just slightly below that figure, you will see that volumes and turnover is actually growing, which says to me that while mostly local investors are exiting and positioning themselves in fixed income, it appears to me that foreign investors are taking the opportunity to come in and taking up these shares at very, very low valuation. So that is something for investors to think about.
Right, and you did mention the interest rate hikes impacting investors in the equities market, but we saw rate hikes from 2022 into 2023 from the former leadership of the CBN and that MPC committee, that team. We saw interest rate hikes, and the equities market still did very well and ushered in the 100,000 level for the first time ever. So what's different about this rate hikes we're seeing at this time?
Well, you must understand that the previous hike was coming from a very, very low base. The previous CBN leadership have had to lower rates to unprecedented levels in order to reactivate the economy of the country post-COVID. We saw a situation where interest rates went as low as 2%. All right, so after the economy was seen to have, kick-started post-COVID, they had to find a way of, taking away the liquidity from the system again by raising rates again. So that's what we saw then. Now, what we're seeing is a situation where there's a continuation of that need to continue to mop up liquidity. And the truth is that the aggressiveness now seems to be much more than what we saw from the previous regime. Because beyond even just the MPR going up, we are saying that other parameters, has also limited liquidity that is available to the banks. So the combination of all those parameters is what is limiting liquidity, which is the reason why we're seeing people shifting their portfolios towards the area where they can get more exciting rates than what is obtainable in the equities market at the moment.
Well,
So
I'd like
really
to
the
get
difference is...
I'd like to get your perspective. What are you expecting for next week and the month of May? It seems it's safe to be bearish this week and this month.
I still think that we're going to probably continue to see a bearishness continue, maybe for the rest of the month. Because again, a lot of the companies that were expecting their earnings reports to come out have already released those earnings reports, though we are going to now start seeing the first quarter results come out. But it's very possible that those first quarter results might not move the needle in terms of equity prices, because the story in the fixed income space is just too compelling. We are not going to see a situation. We are not going to see a situation where some of those companies might be declaring interim dividend until maybe July. So if that is the case, it's likely that we're going to continue to see a bearish market, possibly for the rest of this month.
So I guess fixed income still looking very, very attractive at this time. Thank you so much for coming on the show, Mr. Olatunde Amolegbe, MD, Arthur Stevens Asset Management, and enjoy the rest of your weekend.
My pleasure, Ladi. Thanks for having me.
Thank you. All right, that's the show for today. Thank you so much for watching. I'm Ladi Williams, and from me and the team right here at Channels HQ, it's bye for now.